Good morning, everyone, or good afternoon or good evening. This is Joe Trevisani. My apologies for the slight delay. We will start in about a minute. I'm just going to put up some of the charts, and then we will go. Today's topic kind of is the only topic, really, and varying from country to country, in the world financial system these days. Of course, it's QE. We just had the ECB this morning. Mario Draghi saying that they will raising their growth forecast and saying that we will to 1.1% next year, implying, I think, that there will be no extensive or really any QE in Europe. An interesting counterpoint to what's going on in the United States and in Japan. We will start in about a minute. Let me just put the charts up, and then we will go. Again, my apologies for being late this morning. Okay, let us start. I again thank everyone for participating and for taking the time out to come. I certainly thank FX Street for their indulgence in permitting me to do these webinars. It is, for me, actually very enjoyable. So I'm going to start with an unusual chart this morning. This is not a financial chart. Now, we're talking about Japan. I'm going to try and do an Abenomics. I'm going to try and do two things. There is a theoretical aspect to this, which has been called in the United States, it's a QE, which has been called an experiment. And it is very much an experiment, because both central banks, actually all the central banks, are attempting to do two things. One, and this is their traditional role, they're attempting to forestall disaster, the lender of last resort, if you will. Also, yes, as always, when I do my webinars, please interrupt as often as you like. I sometimes think maybe I should become a teacher, since I like being interrupted. Abenomics is simply a neologism, that means a new word, from the name of the Japanese Prime Minister, Shinzo Abe. So it's a natural, Abenomics. So it is a theoretical aspect to this. Anyway, back to where we were. The point, well, to forestall, as I was saying, they're trying to do two things with this. Yes, it actually is Abenomics, Abe economics, but you shorten it, as all the witty writers in the financial world like to do, to Abenomics. I don't know who came up with it first. It's a natural. But I don't know. I suppose we could look for the first, we could do a Google search and look for the first occurrence of Abenomics in print, and then we could say that that's the person who coined it. I don't really know. So the central banks have two roles, of course. At least they're trying to do two roles this time. The first one is the traditional role, the lender of last resort. Well, the lender of last resort in the modern world means the forestaller of disaster. And that is what both the Fed has been doing ever since 2007, and the Bank of Japan has not really been doing the same to the same degree, because there hasn't been the same problems in Japan relating to the banks and other things from 2008. And the ECB certainly. In each of these cases, the pending disaster was a little bit different, actually a lot different, but the bank fulfilled that traditional role of lender of last resort, transmuted into the modern world. The second role that the central banks, and that is their traditional role, and it is something that they have proven very good at, is in fact the reason why central banks exist originally, to prevent the financial system, to prevent bank runs. Although, frankly, in the Depression in the United States, the central bank was not very good at preventing bank runs. And it took the deposit insurance for that to happen. But traditionally, bank runs were not really a function of the depositors, but a function of a bank's liquidity problems. But that's a different topic. So the central banks are fulfilling that role now. But they are now attempting to fulfill a second role, and that is the promoter of economic growth. That is what the Fed has been doing. That is what the ECB has not really been doing, a little bit, at least not through the same methods. And certainly that is what the Japanese have gone into wholeheartedly with Shinzo Abe and Kuroda, the head of the BOJ. For this role, one, it's a new, at least to the degree that the central banks are trying to promote growth. Before this, their role was lender of last resort, as I said, and a la Mr. Greenspan from the 80s, a smoother of the business cycle. Well, the smoother of the business cycle, once that intellectual leap was made that the bank has the capability and the desire, and perhaps the legal obligation, at least in the United States, to facilitate growth, to smooth the business cycle, the intellectual leap to where they are now was very small. They'd already made it. That once you enter into the idea of helping to regulate and promote the economy, then the theoretical move to where the banks are now is not very large. So one more point on the sort of the theoretical side of it. By the way, this is a chart of the Japanese population, and that's the end of last year. Because these are yearly numbers. The numbers from the date line on are projections. So the reason this has been termed over and over again an experiment, frankly, not often enough, I think, is because, one, it's never been tried before, and two, nobody has any idea whether it's actually going to work. It is clear that central banks can prevent catastrophe. Financial systems are built on what? They're built on confidence. They're built on the belief of the participants that they'll be able to get their money out when they want, and that the sleight of hand, really, involved in a banking system will not be called into question. Because, of course, as we all know, at the base, a bank maybe keeps a tiny percentage of deposits on hand in case customers come in and ask for their money. Therefore, it depends. It exists on the sufferance of its depositors, that they will not ask for the money all at the same time. So that is confidence. That's true when banks deal with each other. That's true when banks deal with depositors. It's true throughout the financial system. Financial systems are built on confidence. And when confidence flees or is questioned, that is when you face the abyss. I'm being grandiose here, but one, I'm prone to be grandiose, and two, having just been through this in 2008, it really was true. But central banks are very good at this. Because why? Well, one, it's necessary, but two, they can do it. It's within both the theoretical and the practical scope of what they have experience with, and they have the tools to do it. They primarily create liquidity and pour it into the banks, into the financial system. It's an extension, and a logical extension of monetary policy. The reason it's called an experiment, QE, is because they're not attempting to do that now. They are attempting to promote economic growth through the use of monetary policy. This is different than trying to smooth out the business cycle and forestall inflation. And we do not know whether it will work, because economies are composed of thousands, millions of individuals and firms which are composed of individuals. And economic growth is a function of confidence, just like the banking system. But confidence in the banking system can be addressed by the government, by the central banks. The question we're looking at is confidence in the economic system. Can that be addressed by monetary policy, by the central banks? I would say that to use a hoary old cliche, the jury is out on this. I think, and I'm going to address the Japanese case in about 2 minutes here. What we're looking at is, because this type of monetary policy has never been tried on this scale before, ever, period. Markets, as we all know, are psychological creatures. You have to some degree, steel yourself to take that position. When economies grow and create jobs, they largely grow on the back of the same type of risk-taking. It is not, as we all know, I've heard it 100 times, at least here in the United States, that it is not the large firms that create jobs, by and large. It's the small firms. And it's not the large firms that create economic growth. The rising curve is the beginning of the business. I mean, I know from my experience with FX Solutions and with Worldwide Markets, it's the rising curve. It's the risk that generates the jobs. And so the question that I think is unanswered and probably not really asked, but I'm going to ask it today, I mean other people have asked it as well, is that does this absolutely prolonged period of low interest rates, which of course the corollary of your low interest rate is that the economy is not doing very well, does it change the psychological risk parameters of the economy? Does it perhaps retard or inhibit the type of growth that Bernanke and Kuroda and probably Draghi too are very much desirous of? Starting to look like that perhaps it does. That it changes the way people interact with the economy. I mean, when I go up and down Broadway, I've mentioned this many times. I live in Manhattan, and Broadway is one of the main streets of Manhattan. And from my house on the Upper West Side downtown, it's lined with stores. It's not primarily a residential street. And I've lived in New York for 25 years. Actually, I was born there, but anyway, I've lived in New York for 25 years. And in my entire life, this goes through several recessions. I have never seen as many empty stores on Broadway as I have seen before. So it's clear that whatever's happening, this is not a normal condition. Okay, now, on to Japan. After all, that is the topic here. Can I define risk? Risk can only be defined, in my mind, in context. Meaning, I can define risk in the markets. I can define risk on a position. It's difficult very much to define risk in, yes. The risk that I'm talking about economically is the risk to start a new business, because that's where the jobs primarily come from. That's the risk I'm talking about in relation to quantitative easing and the growth or lack of growth in the economies. It seems to me that that type of that willingness to take risk is inhibited and has been inhibited by the permanent low interest policies that we have here. But there are many different kinds of risks. There are personal risks. Skydiving involves personal risk. I can't say that I've ever done that. This chart is a chart of the Japanese population. And the reason I'm starting with this is because what the Japanese government is attempting to do and what they are attempting to forestall, they start with deflation and they end with, yes, you're right. Low interest you're correct. Low interest, now, the assumption on that is that low interest means loans, and that's correct. Two problems with that. One, it's very difficult to get a loan now. And two, in order for someone to be interested in taking out a loan, they have to see a purpose for it. Flip it around. Low interest rates do not create loans. Demand is what creates loans. The Fed has been pouring money into the economy for 5 years. The economy isn't really growing. People are not really taking out loans, low interest rates. One, it's harder to get, but two, they don't see the risk parameters returning to them as far as investing in a business. So it's demand that creates loans. What is happening with all the money that the Fed? It's not being lent out to create new businesses by and large. Money is not being created. If you look at, and I have a chart of this, it's not being used to create money. Okay, well, let me talk about that in a minute because otherwise we will never get to the topic that I'd like to talk about, which is Japan. So this is the chart of the Japanese population. Now here, let's look at this is the primary focus for the Japanese government central bank. It's what they've spoken about most. They want to end deflation. This chart is, I think this is a 30-year chart, yes. Okay? So, this is the zero line here. Right here. That means with a number of breaks, Japan has been flirting with, not flirting, has had deflation in their economy for 20 years. Sometimes it peaks into inflation, but it never gets higher than 2%. But all this period here was deflationary, and since the crash in 2008, yes, thank you for reminding me. These charts, most of these charts are from Bloomberg. The blue and black ones are from my Bloomberg terminal. And this code right here is simply the Bloomberg code. If you have a Bloomberg terminal, just type that in and then hit go, and you'll end up at this chart. This is just a Japanese inflation chart. So remember, I started with Japanese population. This chart. Now, one of the things that the Japanese government has been doing, let's look at another chart. And this is, let's look at the JGB rate. Okay, this is the JGB rate, that's the Japanese government bond, over 30 years. Look at this period here, from 03 on. If you do an average, you see that the JGB rate has been under 1% for much of that time. Remember, the Fed rates were 3 and 4 and 5% up until 2007, and much more normal. Let's look at the year. This is the JGB rate over the past year. If you go from here in April to here in May, that's a little bit more than a month. The JGB rate doubled. This is the Bank of Japan's biggest problem. But let's go back to where we were. Let's take a look at the inflation rate. Okay, this is the inflation rate. One of the reasons that the Bank of Japan has been able to keep interest rates on JGBs at this level? Two reasons. One, because the inflation rate has largely been deflationary for much of that period. What does that mean? That means prices are dropping. That means the value of the money that you're earning. Yes, I do have, I actually do not follow, I do sort of follow Kyle Bass. I mean, I have one of his articles here as some of my background here, yes. There's nothing original to what I'm saying here. I don't want anyone to get the idea that I have made all this up and thought all this up on myself. No. This idea of population decline and its effect on an economy has been around for some time. I find it fascinating because it is not something that markets tend to focus on, because markets trade on they don't trade on trends that are as long as generational. But a decline in the population is generational. So one of the reasons that, and it's cultural. One of the reasons that JGBs and people would accept the return, such a low return on JGBs, because the return was being paid in deflated dollars, which means that it's worth more, and two, for much of that time, the yen. Let me get a longer yen chart. Hang on, sorry, a longer yen chart. I do not have a longer yen chart. My mistake. Apologies. But we all know where the yen was for much of this period. It was around the 75-80 level. And it was declining into that. So you're getting paid in yen, but the yen is worth more because of deflationary prices in Japan, and the yen is worth more on the international currency exchange because the yen is stronger. So, for those reasons, the JGB rates, and there are other psychological reasons as well, but the JGB rates were tolerated. So, now we have Japanese GDP. Let's take a look at it. I know I have GDP here somewhere. Maybe I do. Oh, here it is. No, I don't. Don't I have? Yes, here it is, GDP. Okay. This is Japanese GDP. This is from a site called Trading Economics. It's publicly available. It's a very good site. Generational trends. Well, let me talk about population in a few minutes because it's a different topic. But just to say shortly, generational population works on, if I were mathematical, I would say an exponential scale. Because what happens is, as the population decreases, there are fewer and fewer people, obviously, to have children, so the speed of decline increases. Because each subsequent generation is that much smaller. But let's not do the math on that, even if I could. So this is the Japanese growth rate going back 30 years. Take a look at this. Now, this is not a great chart. We're 5% here, 3%, 2%. And through here, it starts to decline and decline. And over here, we end up with 0, which is what it's growing at now. Now, if you look at this, part of this, these bumps here have these rises here, were Japanese fiscal stimulus to the economy. But this, if you take the longest run, is a declining growth rate from over 5 to 0. Now, that probably has more to do with this than anything else. The decline of population. So what the BOJ is trying to do and take another look at this. This is balance of trade. This is actually more interesting in a way than the graph on the GDP. Japan has an export and still does, an export-dominated economy. In order to sell products, you have to have products that people want to buy. Something has happened, it seems, to the type of products that Japan is offering. When I was in college, I remember when the Walkman came out. The sound, it was first on cassettes. Many people here probably don't know what cassettes are, but it's a tape. It's tape. It's analog recording rather than digital. And I remember being astonished the first time I heard a Walkman in the headphones, how good the sound quality was. Absolutely astonished. The curve of product innovation has moved well beyond Walkman. As a matter of fact, I can't really think of any world-beating product that has come out of Japan. Now, I'm sure I'm wrong about this, but I just can't think of any right now. But certainly nothing to compare with the innovations coming out of the American computer industry. So what has changed here is perhaps a function of something deeper within the Japanese business culture than simple economics over time. It is true that most innovators and most risk takers are younger rather than older. And whether or not that difference is affecting the Japanese economy is something that will be very difficult to quantify or prove, but my guess would be that it is. So, what the BOJ is attempting to do, and as far as domestic prices in Japan, price is a function of supply. This is not very brilliant on my part. Of supply and demand. Well, if the supply, let's assume that the Japanese, remember, we're talking about domestic prices in Japan, because one of the things that the Japanese government is concerned about is deflation. Because deflation does two things. Well, outside, vis-a-vis their outside factors for the economy, it tends to strengthen the yen. If you have inflation in Japan, or higher inflation, then it would tend to devalue the currency. We all know this in sort of traditional currency measurements. So, Japan has deflation. Okay? So as I said, we have supply and demand in Japan for domestic products in Japan. Let's assume that the supply doesn't change. Sony makes as many tape recorders, well, CD players, as they did last year and the year before. However, as the Japanese population ages, it buys fewer of all of these things. Less demand means lower prices. Now, what the Bank of Japan is trying to do, let's look at some other issues here. So I'm dealing with deflation first because that's the first avenue that the Japanese government is trying to address. So let's take a look at M2. This is a 2-year chart for the money supply. What they're trying to do, and they've said, is to get inflation to 2%, to defeat deflation. So you can see the money supply has been rising. Okay, that's standard, straightforward, monetarist policy. You create more money, and everything else being the same, you should get some sort of inflation. The problem is here. This is the velocity of money. If you get a rising money supply and a falling velocity, nothing's going to change. Yes, you're right. That's true. The Japanese do that, but either way, you could see the Japanese economy either as innovators or excellent copiers. But either way, you must come up with products that, one, the world wants to buy, and you must come up with products the world wants to buy. And you can't copy Apple. And that's what the problem is. So it has gone beyond the availability of products that people want to buy. Let me put it another way. It's no longer enough, apparently, to simply create products that are as good as everyone else's and cheaper. And there are a number of reasons for that. One, there are products that are simply better than others that you can't duplicate. And two, the Japanese are no longer the most efficient and cheapest producers. For cars, the Koreans are. For many other things, the Chinese are. So if you can't keep your economy running by simply making the same products cheaper, then you need to make products that people want to buy. Since the Japanese have moved far closer to the higher end of the cost scale, they have a problem. And that's something else that's been going on. So the Japanese government, under Mr. Abe and Kuroda, now these are the guys, he was been prime minister before. I think Kuroda has not been, I think he was finance minister the last time, not BOJ head. I believe some of these, they were in power. I don't actually know the years, but they've been in power before. And throughout the past 25 years, we'll look at the JGB rate, but the rates have been incredibly low. The policy that Japan is trying now has been tried to some degree. The only thing they're doing now is and I've had arguments with this with other analysts. They say, and I say, no, this is the same policy they've been trying all along. And they say, oh, no, it's not. But it is. The difference is the degree. But from my mind, as I said earlier with my introduction, the degree does not change the basis of its interaction with the economy, which for me is how it intersects with the people who create growth in the economy and the overall tone of the economy when it's simply muddling along and everyone is just making do with the profits available through low interest rates. Okay, so this is the velocity of money. Well, the velocity of money in Japan has been crashing, shall we say? So that goes a long way to negating what the Bank of Japan is trying to do. Now, let's take a look at. I have a U.S. velocity of money here as well. Let me just find this. Here's the U.S. velocity of money. Same thing. One of the problems that's going on in the QE programs of the United States and now of Japan is that it is not actually creating money that circulates through the economy. And if you don't have money circulating through the economy, then it's very difficult to create inflation. Mr. Bernanke has been absolutely right about this from the very beginning. When he said there's not going to be any inflationary threat from the QE programs because of the lack of demand. He's been absolutely right. Of course, it sort of counters the idea that creating money will make the economy grow. Because it's the same issue. Just as inflation does not rise when money is created necessarily unless there is demand for it, so business loans used to create businesses or to expand businesses are not automatically created by the availability of very cheap liquidity. They're created by the demand. They're created by the other side. They're created by people saying, I have an idea, now's a good time to try and put it into play. That's what creates demand. So on the one hand, the Fed will say, well, we're not going to get any inflation because there's no demand, but it says we're going to help the economy by creating loose money because that's going to create demand for loans. It hasn't and it won't. All of the central banks are constrained and inhibited by what they can actually do. None of them really have control of financial policy. They don't. They have monetary tools, and that's pretty much it. Quantitative easing is just low interest rates by another name. It's the same policy tool enacted with the Fed funds rate. Same tool. It's just worked out differently. Okay. Okay, let me answer one of these questions first. I'm going to ask it with a question. Why is it breaking below 99? Let me ask the reverse question. Why did the Japanese yen get to 103? What did the BOJ actually do? What did Abe do? What did the Japanese government do? What did it actually do? It didn't do anything. Correct. That's exactly right. The Japanese did not intervene in the currency markets. They said that they're going to flood the economy with money. And they've started to do some of that. But it doesn't mean, because of the lack of demand, that flooding the economy with money is going to create inflation. And there's another problem, of course. The JGBs that are out there, yes, I know we always hear they're held by everyone in Japan, so it doesn't matter. That I do not believe. So, if the Japanese goal is to get 2% inflation, then why would you hold a JGB that's paying 1%? Not only that, but if you are a financial institution, the value of your assets, the JGBs on your books, are about to plummet. At least that's the fear, because inflation is rising. So the natural reactions of a threat of inflation from the government means lower JGB prices, means higher interest rates. And what does higher interest rates usually mean for a currency? It usually means a stronger currency. Now, I don't think that right now is what's making the yen come off. It's that the rise in both the Nikkei. Let's take a look. And let us all remember what markets do. Markets trade for trading profits. I know it sounds kind of childish. Let's take a look at the Nikkei. This is a 90-day chart of the Nikkei. Look at that volatility. The Nikkei is now off, I think, about 21% from, let me see if I have a longer, I think I have a longer Nikkei chart. Just hold on. Yeah, 12, 13. Okay, this is the Nikkei. The Japanese interest rate, the Japanese stock market over the past 2 years. That is some chart. Below 9,000, I think it was about 8. It's actually a little bit lower further back to almost 16,000. If you take that longest run, it's almost a 90% increase. It's 87%. I figured it out yesterday. Now, what do you think that reason is? Is it because the Japanese economy's prospects with this untested Abe economics plan have become so dramatically better that everybody's suddenly become an investor in Japan? Or is it, like so many of the other markets, with the massive amounts of liquidity floating around, which many financial institutions and their customers have access to, and with no returns anywhere, where do we go? We go right here. The statistic I read in an Ambrose Evans Pritchard column, he writes for The Telegraph, and I don't know where this figure comes from, is that 1/3 of the long positions in this period were foreign hedge funds. Are hedge funds interested in the long-term economic growth of Japan? Well, maybe some of their investments are, but their trading investments most certainly are not. Their trading investments are interested in trading profits. That is what drove this. Speculation. Not a bad word, but a word. And who gets the most profit from a speculative position? He who jumps first, both in and out. The judgment made by the people participating in this run was a psychological judgment. There may be some part of it where people are thinking that the policy that Abe and the Japanese government is putting in will work. Therefore, the Japanese economy will grow faster, and that's a long-term benefit. But by and large, this is just like the collapse in the, actually the rise, I'm sorry. Yeah, yeah, that's true. The rise in the European debt markets from last summer, when Mr. Draghi said that he will defend the euro at all costs. At that point, the people who had gone short said this is a time to go back. It is a trading decision. If you're looking at a risk-reward ratio for your position, you've got profits stacked in your position, just as this. And there's a, as they say in the law, a material change, then you take your profits. And that's what's going on here. There is no indication from this chart that Abenomics is going to work. There are, as I've said, contradictions inherent in the program. So let's take a look at the JGBs again. This is the 30-year JGB. Okay? The problem is this. And this is the basic problem with the program. Well, let's just take a look at one other thing first, and that, of course, is the yen. What does this look like? There's no. Let me get to that. That's a question not it's not pertinent to the webinar, but I'll be glad to answer. Just let me do it in an email. Okay, so we're looking at the yen. That's the yen. Okay. Now let's take a look at something else. Somebody find it. Hang on. What did I do with that Nikkei? Okay, this is the Nikkei. Whoops. Sorry. Okay, here's the Nikkei. Here is the Nikkei. Dum-da-dum-da-dum. Of course, they're both based on the same idea. That if you're looking for an avenue and a market that's going to move based on not so much economics, but the psychology of trading and what the respect and the involvement that traders will have in pronouncements, especially new pronouncements, from central banks. It's the old idea of don't buck the Fed. Same thing here. And so what we're seeing here in the decline that we've seen from 103 down to 99 is a recognition that this particular move has gone as far as it's going to and it's time to take profits. That's what we're talking about here. Neither of these is meant to be a judgment on the success of Abenomics or the potential success of Abenomics and what the BOJ is trying to do. I don't think it's going to be terribly successful because it's based on a premise that doesn't work, or at least has been proven, at least so far, has had very little efficacy in changing economic behavior. Remember, the premise of quantitative easing, one of the premises, is that vast amounts of liquidity, loose monetary policy, can change the economic behavior of the country, meaning of individuals. That's the basis of it. That's a psychological basis. That's why I started out talking about confidence. That it will affect the participation rate, if you will, of the economy. Another way of putting it is this, and this is probably this is probably the best gloss that you can put on quantitative easing as far as an economic policy goes, is that it will supplement the natural cyclical tendencies of an economy. Meaning that as an economy falls into recession and falls out, the upward movement of that economy will be aided, and this is traditional monetary policy, will be aided by loose money. Counter-cyclical monetary policy, traditional monetary policy. As the economy falls down, you lower rates. As the economy rises, you raise rates to prevent from. That's counter-cyclical monetary policy. And you have the same idea here. Although this is not counter-cyclical, this is pro-cyclical. Because as the economy is rising, in fact, the economy has risen from the depths of 2008 and 2009, but because it's so weak, so you have a pro-cyclical monetary policy. But the idea is the same. The possibility, perhaps, which did not really arise, because one, they've never tried this before, was that too much liquidity may have a counter-cyclical psychological effect. This will be very difficult to prove, but if you look at the history, let's see if we can find this one. Let's look at Japanese, and I don't have a... okay, let's look at the JGB rate. Okay, this is the 30-year JGB rate. So since 97, it's been below 2%. And if you do a median on this, it's probably just over 1%. Okay? Then let's look at the GDP. Let's make these comparable. These are about the same time periods. There isn't any indication from Japan. Now remember what I said. I consider quantitative easing nothing more than an extension of low interest rates. So you can take this as a proxy for, or a substitute for permanent quantitative easing, if you will. And there's certainly no indication that permanent low interest rates have any beneficial effect on the economy. Japan has been in the doldrums for 20 years. The entire time, almost, the Japanese have had extremely low interest rates, especially by historical levels. It seems that one of the things that, well, don't forget, this was the period of the carry trade here too. Why? And again, that's another thing which ended up perhaps counterintuitively strengthening the yen, because what happened was, during the carry trade, people borrowed in Japan and sold the yen and took the money overseas. Well, once that trade ended and it crashed, the yen strengthened tremendously, and it has nothing to move it from that area since. So it is possible that low interest rates, meaning very cheap money, tilt an economy away from productive investment and to financial investment. And the reason I say that is because if you can borrow cheaply and then do something else with it, it is a lot easier, especially for the people who borrow. I mean, who has access to the money that's created at these very low interest rates? It's by and large people with, or institutions and firms with credit. Those are not the people and the firms that create jobs. So you end up with, say, something like, I mean, I don't know this for a fact. I'm just using it as an example. A firm like Toyota, which has very good credit, I assume, and they can have access to all of this money because of their credit. So what do they do with it? Do they use it to build new plants someplace? Perhaps. But what else could they do with it? They could also create something like GE Capital and use it to trade and make trading profits in the financial markets. And if you look at the world financial markets over the past 10 or 15 years, part of the facilitation is because of electronics and the ease of flinging money around the world, but part of it is because of the access to capital. And so the possibility exists that permanent low interest rates in an economy tilt the economic system, and certainly the financial system, towards financial speculation and trading. And that, to my mind, undermines, because after all, I mean, founding a company, trading, it's largely about making money. Not entirely, but largely. And so you have to make a choice between, you take a loan out, and you have to make a choice between founding a company and perhaps becoming, a trader. It's easy, and perhaps it's certainly easier to open up a trading account and to start a trading business than it is to found a business. You don't need a particular idea to become an oil trader or anything else. You do need a particular idea, and it's much harder work to found a business. So the problem with Abenomics is the same problem with QE in the United States. I was listening to Bloomberg Radio on the way in, and they were talking about whether or not the Fed is going to end QE. And how do they end it gradually so that it doesn't shock the markets? To my mind, that is a profound misunderstanding, not on the Bloomberg commentators' parts, but that's a profound misunderstanding of how markets work. The same as with the Nikkei or the yen or anything else where there is an enormous amount of trading profits. you got to get the profits out of the market in order to make money. So both for Abenomics and for QE, as soon as the markets, especially for QE in the United States, but as soon as the markets sense that the Fed is going to begin to end, they don't have to wait, and markets are not going to wait for it to end. They're going to jump all the way at once. There's no sense that the credit markets or any other market is going to decline gradually because the Fed is taking their purchases from 85 down to 70. What the markets are going to automatically assume is that QE is on the way out. And it doesn't matter how long it takes. Because if I'm long a bond and I sell now, if I wait, it's only going to be lower at some point in the future. So there really isn't any sense that markets are going to be able to moderate their reaction to a change in economic policies or a change in monetary policy. The only thing the Fed could do, I suppose, would be this week say we're going to end and next week say we're not going to end. Well, that's not going to work. So for the Fed, the sense that they will be able to ease out of quantitative easing, and no pun intended, and prevent the potential drag on a weak economy from higher interest rates seems to me to be Panglossian, if you will. It's something that markets really can't do. We have the same type of contradiction in Japan. What Abenomics is trying to do is to defeat deflation purely through the use of monetary policy without changing, that is the supply side, without changing the demand side as well. There's been no indication that that will be successful. In addition, the policy has an internal contradiction in that as long as their goal is to create inflation, they guarantee selling pressure from the credit markets. So the only way to prevent a collapse in JGG prices and a rise in yields is for the Bank of Japan, which it has been doing, to stand underneath and prevent it. In other words, to buy all of the JGBs that are on offer. And they have been doing that. Currently, I think the Japanese BOJ is taking about 70% of the Japanese, covering about 70% of Japanese government debt. Just one second here. Similar, everyone should note, to what the Fed is doing. The Fed is buying about 70% of U.S. debt. Excuse me one second. And the contradiction is the same. So the Japanese government and BOJ has a very poor history in this. Markets will always speculate on new information that has come out of governments. We are in a central bank world. That's an interesting question. Let me answer that. If you look at inflation charts in the industrial world over the past 30 years, what you see is a very pronounced decline in inflation. Inflation is, if inflation is too high, there's an interesting statistic I read recently that from the 15th or the 16th in England, from the 16th century to the early 19th century, prices pretty much did not change. If you were buying a bushel of wheat or a horse, when Chaucer was alive, when Shakespeare was alive, and when Richard Burton was, not quite Richard Burton, but when Wellington was alive, you paid pretty much the same price. Central banks and fiat money are the creators of inflation. There's a long intellectual argument about the benefits of inflation as far as an expanding monetary regimen. In other words, if money isn't, if the population grows and if you want the economy to grow and there's not more money, it will constrain it. Deflation from an economy, I am saying that, let me start this again, you've got me thinking on this. Inflation, central banks invented, figured out how to prevent inflation, starting really relating to Milton Friedman monetarist policies and as enacted certainly by Paul Volcker under Carter and Reagan in the United States. Inflation was somewhere 10, 12%, maybe more than that. It's now, in the United States and in Japan and much of the world, well under 2%. The Japanese government is attempting to defeat deflation. Deflation is falling prices. Not disinflation, where you have lower prices, but deflation, not disinflation where the rise in prices are declining, but deflation where you actually have a fall in prices. What that does to an economy is it forestalls consumption. If I'm going to buy a house, but I think that 6 months or a year from now, the house will be worth less, I might very well be disposed to wait. And that's true of many, many other purchases. It also means that savings become increasingly valuable. So it inhibits economic activity. People don't buy as much, and people are more prone to keep their money in a savings account rather than use it because it'll be worth more. So that is why both inflation and too much inflation and deflation are feared by economists and economic planners, and they can be damaging, certainly, to economic growth and economic activity. So yes, it is true that too much inflation is feared. But central banks have a reasonably good idea about how to prevent inflation, or at least to control inflation. The problem is they're using the same set of ideas to prevent deflation. And if there is enough demand in the economy, then I think the monetarist approach to deflation, which after all is all the central banks really have, will work. But without an adequate demand, and this leaves us back to population, then monetarist policy, I don't think it can have its expected effect. Okay, what do we think about the dollar? The dollar is very much riding on what the Fed is about to do. There's no surprise with this. I'm not saying anything original here. I think that the Fed, let's put it this way. Whenever the Fed says something, certainly Mr. Bernanke, but the others as well, it's calculated. There are no innocent utterances from central bankers or members of the central bank community. Nobody goes out to a bar and then comes out and starts talking to reporters. That's not the way it works. So when the Fed deliberately started, and remember, when you're talking about the Fed and people look to their released minutes as signs of what they're about to do, remember those minutes are edited. It's not a transcript. They're edited. They are, I have to finish in 3 minutes. I thank you for the extra time. Maud and Vicki, I realize a little bit late this morning. I apologize. I'll deal with these two questions and then we will end. I hope this has been useful. So the minutes from the Fed, which everyone parses and tries to figure out what they're trying to say, are edited transcripts. They are deliberate. They are part of their communication policy. They are not transcripts. Transcripts are not released for something like 5 years. And the transcripts are far more, and there's a good reason they're not released for 5 years, because they reveal, one, a great deal more uncertainty than people would like to think central bankers have in their analysis of the economy and in their ideas about what they need to do. So when the Fed and Mr. Bernanke started dropping hints of tapering, what they were trying to do, one is test the waters, but two, to make a gradual approach to a change in policy. Now, whether this is because they, and Mr. Bernanke would probably say that the economy is improving enough, or because they're starting to realize that the balance in the economy being forced by the perennial low interest rate and QE policy is starting to do more damage. Let me give you an example. Then good. Housing prices are up 10% in the United States year on year. Unemployment is 7.5%. It's actually about 9 or a little bit more, because the reason it's 7.5% mostly is because people have stopped looking for work. Wages are essentially static. So we have 7.5%, 8.5% unemployment. We have static wage growth. Yet, we have housing prices rising 10%. Does that make any sense? Yes, of course it does. In terms of investors and speculators buying houses to resell them. Now, where's the money to fund these purchases coming from? If you're buying a repossessed house, my guess is you're buying it for cash. Hedge fund or whoever's buying it. So where's that money come from? Did they have that money? No, they borrowed it. Where did they get that from? Well, they have access to the liquidity the Fed is pumping out. So, as with so many other markets, they are subject to a search for yield. So the Fed is looking at this and they can see that housing prices are rising dramatically. That's something which is not necessarily good for the economy. It is, I suppose, if the economy is growing very strongly, but that's not the case we have here. So the balance in the FOMC is shifting. What reason it's shifting for, because some of the people on the FOMC, and I'm not a real Fed watcher, some people on the FOMC are probably saying that the economy is starting to get stronger, so we can probably taper off QE. The other people are saying, well, the damage is increasing from what we're doing, and so maybe we should stop it. Either way, the concept that you can taper QE and have a tapered effect in the economy, in the financial markets, it seems to me is totally misplaced. So that is what is more important for the strength of the dollar than anything else. When we saw the Fed begin its tapering talk, the dollar strengthened. And as they've withdrawn some of it, the dollar has fallen. And I think that is still the determinant in what we're seeing. Gold. Gold is an interesting question. I think it's back above 1,400 if I remember today. Gold has I always view gold as having three components. I call it the I wrote a column once called "The Three Faces of Gold." It is the people who are concerned that the world's about to end. It's the people who are concerned about inflation, and it's simply traders. One of the reasons gold price has been falling are because two of those participants don't believe that there's going to be inflation and it's time to take profits. So a gold price falling is not necessarily a sign of a recession. I think maybe next time I will actually do a topic on gold. Again, I thank you all for participating. I hope it was useful, or at least it had sponsored some thoughts. I will put my email address up there. If anyone is interested, you can certainly email me any questions or any comments, and I will be glad to answer. Again, thank you all very much for taking time to spend with us here at Worldwide Markets and to listen to my comments. Thank you very much. Everyone have a good day.